Welcome to this episode of Under the Tamarisk Tree, and thank you for listening. If we haven't met, my name is Phil Harwood. I'm the host of this podcast. I'm a business attorney located in Grand Rapids, Michigan. I'm focused on succession planning. So we're under the Tamarisk Tree talking about succession planning today with Shina Culberson from Quist Valuation. Welcome, Shina.
Thanks for having me.
I'm very excited because you're one of our key partners that we work with. We use your software solution. And so I'm just really interested to hear about your perspective on valuation. And obviously, it's a critical piece to succession planning and estate planning and all kinds of other purposes. There's lots of different reasons people want valuations. And and I always approach this subject, and I'm curious to have you maybe correct me or inform me of a better approach. But I always think about the simple napkin valuation that everyone does while they're having a beer, right? Like they just think about their revenue for the past, or their EBITDA for the past, 3 years, and they're like, okay, quick math on a napkin. Here's your valuation. Well, obviously, there's more to it than that. And we're using your product to create a comprehensive valuation. And then at the other end of the extreme, I think, is the IRS certified valuation. And maybe there's some in between things. So you're going to educate me and everyone else as we talk about this subject today. But thank you for being here. Um, so let's start with this. So your firm is Quist Valuation. Interesting name. But tell us about your company.
Yeah, so again, thanks for having me. Valuation is my favorite subject, so I can talk about it all day, every day. Um, but Quist Valuation, we are a 40-year-old
Wow.
independent business valuation firm. I like to say the only thing that we do all day, every day, 365 days a year is business valuation. Um, we ourselves, I think this is kind of interesting. We ourselves are on our third ownership succession planning. So
Really?
the firm was originally founded by a gentleman named Pete Lindquist. I actually have never met Pete,
Wow.
um, which is very unusual.
Yeah.
And he created a really strong brand. People still today call me asking for Pete, and
Wow.
he's been long retired.
Hmm.
But it's really, really great to be part of a firm and a brand that has such strong market recognition. I mean, we are a mid-range regional valuation firm located here in Colorado.
Hmm.
But like I said, we're on our third ownership transition ourselves. So I feel like I personally understand both the emotional aspects of transitioning your business as well as some of those just, that hard math
Hmm.
that you reference that, am I going to use a back of the napkin sort of benchmarking to understand the value of my company? Am I going to hire a specialist? And obviously, I recommend hiring a specialist. Even for myself, it's hard to
Hmm.
get perspective about something that's so close to you. So I understand all the
Hmm.
emotional parts of ownership transition. So I'm happy to help educate your listeners on this topic.
Yeah. So with Quest, there's three different types of valuations that I'm aware of. We use one more extensively than the other one, um, and and then there's the IRS certified category, which we haven't used, and I don't know if we will, but who knows? Who knows where life will take us? Can you kind of walk us through those different types of valuations and what they're used for?
Absolutely. Um, So we provide, first and foremost, we provide what's called certified valuations. And that's what you're referenced before.
Yes.
Something that, you know, performing a business valuation that falls under specific standards of professional credentialing, professional conduct that meets either tax or regulatory or litigation needs. So those
Mhm.
are some things that we put under the bucket as certified valuations. They're done by credentialed analysts that have gone through all the education and have all the experience required
Mhm.
to meet certain standards.
So would those come into play like in a bankruptcy situation or a divorce, or what, when would a certified valuation be required?
Great question. So anytime you're doing any sort of wealth transfer planning, that might you might report on your tax return. So that could be estate, if someone passes away, a family member, it could be
Mhm.
complex gifting into trust or a charitable donation, divorce, litigation. Those would all fall under or financial reporting. If you're
Mhm.
issuing options to employees or some sort of profit interest plan that have to meet certain financial reporting requirements. So those all fall under some sort of compliance regulatory
Got it.
umbrella.
Okay. Okay.
And so from there, though, we provide, as you mentioned, two um, what we call kind of software solutions or platform solutions.
Mhm.
And we really created those solutions for business owners that didn't need, this sort of high compliance
Mhm.
regulatory valuation approach. Obviously, just the sound of it makes it sound very extensive, kind of lengthy to put together,
Mhm.
more costly. So we have these platform solutions that really are meant for business owners to do planning.
Yes.
They're really meant for business owners who may have never have had a valuation done before, don't know how to think about what sort of approach would I use to value my company? What are the drivers of value for my company?
Mhm.
How do I think about improving those drivers to grow future value in my company? So these two solutions that we have are really meant to help in a planning aspect. And we have two solutions. One is called Spotlight. That's a really sort of quick understanding
Mhm.
of a business owner's um, company's profitability compared to their peers, what sort of multiples would be garnered in their industry. And then we ask a few questions around the business owner's readiness to transition, as well as the business's attractiveness to transition.
Mhm.
So that's a very quick assessment.
Great
And
starting
then,
point.
yeah, a starting point. And then from there, we have what we call just our advanced assessment.
Mhm.
And that assessment focuses more on both the intangible and tangible drivers of value. So it's going to ask questions around your employees, your customer base, financial management, your organization. So that's like systems and processes and
Mhm.
communication methods, your strategic value. So that is, your brand, the barriers to entry, the market opportunity for your industry. And then we ask a few questions around the governance, how decisions are made within an
Yes.
organization.
Mm.
So those are what I call the intangible drivers, but are there to support future revenue growth and profitability. And then we really focus in on the cash flow generating ability of a company. So that advanced assessment gives an overall business score. It talks
Mhm.
about the value gaps in the company, as well as then provides recommendations on what to do to close that value gap to drive future value.
Yeah, we really love the advanced product because it really supports our consulting work that we do. We're really trying to work with companies ahead of an exit, and so if we have time, then we can work on some of those value gaps, those value drivers, and really come alongside them, whether it's process improvement or realigning their leadership team, or getting the owner off the org chart. Obviously a lot of the owners are the problems in the companies, and everyone knows that. And so, we're always trying to work on the owner, but so it's a lot more than just, oh, here's the number. It's understanding, what's driving that number, what's behind it. And so we love that process, the process of asking all those questions and the um, understanding a business at a really deep level, way at a much deeper level than just financial performance. If someone just sent me 5 years of P&Ls, that's great, but there's way more to the story, as we know, like what produced those P&Ls, what resulted in this information, and help me understand what's going on here. We have to ask a lot more questions than just send me 3 years of P&Ls.
That's right. That's right. And that's what's really important to understand about business value in general, that it's a combination of revenue, growth, and profitability, coupled with those intangible drivers that you've talked about. Key man risk, customer concentration, making sure you've got systems and processes in place. Um, so, that's the other part of the equation. And hopefully, as you grow revenue and profitability in your company, you're working on those intangible drivers of business to de-risk the business. And if two of those things are working at the same time together, that's where companies really get that exponential value growth.
Mm-hmm.
That's what
Right.
we're aiming for as
Yeah,
well.
for sure. 100%. That's what we're working on with our clients as well. Can you put in layperson's terms, kind of the methodology of discounted cash flow methodology versus multiplier methodology? Because those can be confusing concepts for people that don't have a business degree. So,
Yeah, absolutely. So, the market approach typically looks at um, comparing your company with other companies that have been bought and sold. So, when other companies have been bought and sold, based on the revenue they've generated or the profitability they've generated, there's an implied multiple based on the price that they were sold. So there's implied multiple of revenue, implied multiple of earnings when that company was sold. And so the market approach is simply, it's the nice thing about a market approach is really simple to understand, right? It's taking
mhm,
your company's revenue or your company's profitability, multiplying it by a multiplier that you see with similar companies that have been sold, bought and sold in the marketplace, and understanding what's an indication of value for your company. So it's really easy to understand. The
mhm.
challenges with it and can range from maybe you're just in such a unique industry, there aren't a lot of transactions to look at. Um, Perhaps there are transactions, but there's not a lot of information about how those transactions were structured. And we all know, or we should begin to understand that price, transaction prices are a function of how that transaction was structured. So,
Yes.
how much cash was paid up front? Was
Mhm,
there a seller financing involved in that transaction? Did the seller have to sign a non-compete or some sort of, employment agreement? So
mhm.
those sort of structures can really impact the price. And so sometimes we don't understand all the
Mhm.
details behind a structure. So those
It's
can
a
be some
great point.
challenges with implementing a market approach. And it's just a snapshot in time as well.
Mhm.
So
Sure.
we all know that there are frothy parts, times in the market,
Mhm.
and there are, maybe during COVID where activity was really low and valuations were depressed because of external situations that were happening in the general economy.
Right.
So we don't always know all those intricacies when looking at a market approach. But again, you know, we
So,
do like to look at transactions because it gives us an anchoring of
mhm.
what the value of a company could be.
It kind of sounds like the market-based approach of valuing real estate. Someone says they hire a real estate broker to sell their house. They'll do a market study and they'll look at comps comparative sales of typical homes. So what you're pointing out is, well, if your home is not typical, or in the case of a business, like you said, if it's structured differently, then the reported selling price isn't really the right price. It's not the accurate price. If you
That's
sold your
right.
house for $500,000, but you really only reported a $200,000 sale because 300,000, because you were contractually obligated to work on behalf of the buyer of the house for a value of 300,000. The $200,000 transaction price isn't the real price. So
That's
even
right.
even the information we have is not accurate.
Yeah, and I think that's a great analogy. Comparing for those of us have bought a home before, going through that sort of appraisal of real estate and understanding what are other homes in your neighborhood selling for, that gives you an indication what to buy a home for. The only difference between real estate and businesses is that the transaction numbers are just so much lower for businesses than they are for real estate. So, you know, um, again, great methodology as an anchoring point, but there can be some limitations of how much you want to just rely on that approach alone, which then I guess brings us to an income approach or a discounted cash flow
Mhm.
method, which is really looking at the company's own cash flow generating ability into the future. And so I personally like this approach because it's all about the company's own cash flow generating ability and what
I do too.
drives its revenue and what drives its profitability. Um, the challenges are is, you don't do discounted cash flow models every single day. It can be a little
Hmm.
challenging. Um, Not every company has a built forecast. Um, and so, sometimes when we work with companies, we really have to go through an extensive interviewing process to really get them thinking about, well, what is going to drive your next dollar of revenue? Where are you going to, is it going to come from existing company customers, or do you have to go find a new customer? How often can you sell to, what percentage are repeat customers?
Hmm.
So we do this kind of extensive interviewing process to help get the business owner think about those things. But I think for any business, Phil, when you work with your clients, it is a great exercise because if you can think about exactly how you're going to generate your next dollar of revenue and what the resources are that you need to have in place to deliver that next dollar of revenue, if you've done that exercise, every day, all day, I'm like, that business owner has a leg up on really understanding their company and how they're going to drive value in their company, not just today, but into the future. And I see a big distinction between those business
Hmm.
owners that have been through that exercise and who haven't been through that
Yeah.
exercise.
No, I agree. I think it's really a great way of approaching this. It's really I think the best way. And it's what's really insightful too, in addition to everything you just said, is to understand the impact of different projection, different growth rates. Because if you're projecting growth at 5% versus 6% or 7% or 8% or 15% out into perpetuity, and then discounting it back to today, those numbers are completely different. And so, how can you justify to a potential buyer, if you're trying to sell your business, some future growth rate? You have to be able to justify that. So there's a thought process about, yeah, I want a realistic number, but I also want to maximize my selling price here.
Yeah,
How high can I drive that number and legitimately? And if we look backward and we say, well, we've been growing over the last, you know, 20 years at 2% a year on average, it's going to be hard to say to a buyer, well, this business is going to grow at 10% a year in going forward. Well, no, it's not, unless
right.
something material changed. So what changed? So it's an interesting way of thinking about, your business really. isn't necessarily worth what it's done in the past. It's more about what its potential is for the future. And then that leads right into our consulting process about, well, what can we change? How can we better position you to have that conversation and support future growth at a higher rate, or just or reduce costs, more efficiencies, or driving profitability. So it's a really interesting, it's a great approach.
Yeah, because it really gets you thinking about the whole business. And I'm sure you guys work with your clients too around, do you have the right infrastructure in place? In terms
Mm-hmm.
of, do you have the right people and the right seats on the bus, right?
Mm-hmm.
To support the organization, or who needs to be traded out, or do you need to add additional resources in any one department to support the company? And so all of that sort of foundation for our company. I know you guys work with your clients on and
Mm-hmm.
help
We
get
do.
business owners thinking about that.
Yeah, for sure. I mean, the organizational structure, the leadership team, um, is really the starting point of that. That's the tip of the spear when you think about organizational structure. And a lot of companies don't have a solidified, understood leadership team. It's a real loose concept. So
Hmm.
we really work with companies to pull that together, because we use that leadership team as the mechanism to drive change.
Yep.
So we use a modified version of EOS. Um, the founder of EOS is Gino Wickman. He was my consultant back in the day. And so we got to work with Gino directly when he was kind of building EOS. And his first book, Traction, I have a couple quotes in it, which is kind of fun. So that's just a really great process. That's off topic here. But I had a question written down, looking at my questions that I had prepared for our interview here, our conversation. Um, I think we answered a few of these, but I hear this word appraisal. Is there a difference between an appraisal and evaluation, or are those just synonyms?
It is a good question. I mean, I think oftentimes when people think about appraisals and valuations, they're using them interchangeably. But I will say from my perspective, um, there, this is how I would separate the two concepts. For me, an appraisal is something that's more formal, and there's a methodical process that needs to be adhered to meet specific standards. So in the valuation world, in the appraisal, or I should say in the appraisal world, there are certain professional standards that we adhere to. So there's USPAP, ASA, there's other valuation um, bodies that dictate standards. So an appraisal is going to adhere to those outside like professional association
Mm-hmm.
standards. And when I think about appraisals, I'm thinking, um, a purpose that is again tax driven, compliance driven, litigation driven.
Mm-hmm.
So it's going to be a relatively thorough assessment of the company. Valuation is just a more informal, there's more flexibility.
Mm-hmm.
So it's more of a generic term, I would say, than appraisal.
Mm-hmm.
Um, but oftentimes they're used interchangeably. The most important thing for you and any business owner when they go on and they want to get a valuation of their company is really just to make sure you're communicating to the expert how you want to use that appraisal or how
Mm-hmm.
you want to use that valuation. And then
Mm-hmm.
they'll go, oh, you need an appraisal that meets these specific standards. Or,
Got it.
hey, we can do a valuation.
Mm-hmm.
Here's how I think the approaches we would use. Here's what our process would look like. And it's just a more informal, kind of more flexible process from there.
Yeah, I think that's good advice. We certainly strive to do that as well, to really understand what's driving, what's the motivator behind getting an appraisal or
Yeah.
evaluation. And in my mind, the appraisal is the certified version, the fancy one. Um,
Yeah. Yeah. Well, that it's the one where, we're under the professional conduct of,
Of course. Right.
adhering to what needs to be in that report. So you're right. It's
Right.
just more formal.
Yeah.
Yes.
Um, so you work with us. So we're a consulting firm and we're a exit planning advisory firm. We met you through the Exit Planning Institute,
Mhm.
um, the EPI. Tabitha, who's on my team, co-founder of the company, she's a CEPA, certified exit planning advisor. So you work with advisors, but do you work with other? Can anybody just randomly uh, call and get a valuation from your team? Any business, or do you exclusively focus on advisors?
So, no, we also work directly with business owners.
Mm-hmm.
Um, but the majority of business owners we work with have been referred to us by another professional advisor.
Got
So,
it.
really, as you know, it takes a whole team to
Mm-hmm.
work with business owners and get some of their planning accomplished. So, the typical sort of team members that we work with are people like you, exit value advisors who's working shoulder to shoulder with business owners to help them grow value in their company. But ultimately, they're probably going to be working with their CPA, who's going to be working on their financial management and quality of their bookkeeping. They're going to be working with their corporate attorney. Maybe they need to put some agreements in place with their employees or put some sort of phantom stock incentive plan in place so that it will work with their corporate attorneys. And then ultimately, they'll also be working with their own personal tax and estate attorneys and maybe doing some wealth transfer planning ahead of any exit or succession in their business. And so those are the four primary types of professional partners
Mm-hmm.
that we typically work with. And so most of our business owners are going to be coming through a referral from one of those
Mm-hmm.
sources. And if they happen to come to us independently, then we're always asking, okay, who's on your team? Because we know it
Sure.
takes a team to get them to from A to Z,
Mm-hmm.
successfully.
So it sounds like you can work in almost any industry. So you're not specifically focused on the service industry or manufacturing or things like that, right? Or any verticals. You probably have some
We're
experience in some more than others, but
Yeah, yeah. Over our 40-year history, it's hard to point to an industry that we haven't seen.
sure.
Um,
What's
and
one of the craziest valuations you've ever had gotten involved in? Like,
this is my favorite question.
okay.
So, I might be dating myself here, but if you or your listeners remember, there was a game called Farmville
Oh
where
yeah,
you bought virtual pigs and
sure.
you bought virtual land, and we were doing evaluation for the company, Zynga at the time,
Mm-hmm.
for their they were issuing stock options to their employees. And honestly, this was such early days. I thought, why are people buying virtual pigs? That sounds so dumb.
I asked
Well,
myself
silly
that
me, it
question more
wasn't
than
dumb
once.
because that company got sold for a lot of money. But at the time, I was like, who's buying virtual pigs and virtual farms? This sounds so strange. I'm really dating myself. This was quite a long
I
time
totally
ago.
remember this. Yeah.
But I was like, oh, this is just so dumb.
Wow. Wow. So very interesting. Um, so how do you get involved in this? I'm picturing, okay, the third grade China out on the place, out in the playground, and you're all sitting around talking about what you want to be, and you say, I want to do business valuations. And everyone's like, what is wrong with you? Like, what sucked you into this world?
Well, first and foremost, it's a good thing I liked math a lot.
Mm-hmm.
But no, my career actually started off in on the fixed income side of the business. So I uh, was a director at Charles Schwab Investment Management. I was covering all of our international uh, credit issuers for the proprietary funds. And so I started off with public fixed income as a public fixed income analyst.
Hmm.
And then which is actually a very challenging part of the market. There's not as much transparency there. And then I moved over to public equities. I was a equity analyst,
Hmm.
a little bit more transparency. And then eventually I moved over here where today we look at nothing but privately closely held businesses. And to be honest, it's the most interesting work. I still love it. I think being in public markets as an analyst, you kind of make a call about, is it a buy, is it a sell, is it a hold, and the rest of the market tells you if you're right or wrong pretty
Hmm.
instantly. This, looking at closely held businesses, it's very nuanced.
Hmm.
Um, every company is a little bit different, even companies operating in the same industry. And so it's really fun and challenging at the same time. Um, but I really think it's fascinating.
Do
It's
you get,
really
well, I
fascinating.
can tell you enjoy it. You love what
I
you
do.
do. Um, do you get to see the fruits of your labor? Do you get to experience some of the wins at the end of the process, with an exit? Or like in our case, I would imagine that you don't have real insight into what we're doing with our clients necessarily, but you have your own clients. So you get to feel some of the change that occurs. And I'm just thinking about my own situation. Like that's what drives me. I grew up in a family business that didn't really have a succession plan, and it motivates me now to really come alongside business owners and help them in their families. And people, sometimes people ask me what I do, and I just jokingly say, oh, I save marriages. Because you get involved in everything as a business coach, and then obviously as people age, you start thinking about succession planning and exiting, and are you going to exit on your terms or not on your terms? And you start having those conversations, but you get to work closely enough where you get to experience some of this. Yes.
Yes. Yeah. I mean, and that is the fun part about the what we do is being able to work with business owners and see them realize their goals and objectives in companies. Probably the easiest for us to see kind of ongoing succession is really with family-owned businesses because they tend
Mm-hmm.
to stay within the family and there's succession planning across the generations. We've been very fortunate to have some um, 100-year-old family-owned businesses that are on to their third generation, which is
Mm-hmm.
really hard to do successfully,
Sure.
where you all still really like each other and want to still have Thanksgiving dinner all together.
Mm-hmm.
And so those are definitely the most rewarding when you help those sort of businesses really um, have a professional sort of approach to a family-owned business, and
Mm-hmm.
those that are really interested in having that what they're doing sort of verified and reinforced by an outside independent third party to come in and say, hey, we what we see here. This over here is causing us concern. We don't see where the value is of what you're doing over here.
Mm-hmm.
But that's where that can be those are kind of the fun clients, those family owned businesses where you're going to see them year after
Mm-hmm.
year.
Right. I mean, the stats are pretty horrific when you think about the failure of making it to the second generation or the third or the fourth or the fifth. It's very rare to get to the third generation. I'm in Grand Rapids, Michigan. I was just reading an article in the local Cranes Business Journal about a fifth generation company called Bissell Vacuum Cleaners. Um, Mark Bissell is fourth generation, turning the reins over to the fifth generation. And it was interesting reading that article and hearing him talk about how he started the succession planning 20 years ago, you know, starting to think about the next gen, like after
Hmm.
him. And
Hmm.
not that everyone has 20 years to do succession planning, but you should, like, it should always be in your mind. Like, I think someone should start a business thinking about how they're going to exit.
Hmm.
How often would you recommend having someone actually do evaluation? Every year, every 3 years, every 5 years? Does it just really depend on the situation?
We recommend once a year.
Okay.
So yeah, so it many of our business owners use that as sort of an annual, obviously it's
Mhm.
an annual assessment of the company, looking back at the last year's goals and objectives. How did those translate into performance
Mhm.
over the course of the year? What's the plan for the following years? So we do quite a few annual evaluations here at the end of the year. And so that is what we believe is best practice unless something material changes
Mhm.
on an interim basis, but it doesn't happen very often.
Yeah, I think that makes sense just to work it into the annual planning cycle.
Yep,
Certainly, once someone's been through it once, it's easier the second time through. Um,
that's
so,
right.
some of the questions aren't as difficult. Um, and I would imagine there's just an iterative process of understanding their business at a more deep level. The first time through, they might be going, I have no idea what's going on here. But after a while, they start to understand it, which is a good thing.
Yeah, I mean, we have a lot of clients that use the process in and of itself as part of their strategic planning, right? So they're
Mhm.
like, so oftentimes they're like, okay, we know we're going to get an updated valuation. We know you're going to ask us for future forecast. So this is our opportunity to really do strategic planning. Think about what we're going to tell you, think about what we're going to commit to ourselves internally so that you kind of just incorporate it as part of their strategy work.
Mhm.
And once we have that initial assessment, when we ask them all those questions, then they start incorporating it into their own management team. And that's where you can really create some really great synergies and in it with the process and really get some uptick in terms of how the company is performing when all those things are aligned.
Totally makes sense. We do
Yeah.
a lot of strategic planning, but even not associated with succession planning, but certainly as you're ramping up for exiting, I think that totally makes sense. Um,
Hmm.
we're going to start kind of heading toward wrap up here, but I want to ask you just what do you do outside of work? Like, what do you do for fun?
So this might sound unusual. So what I do for fun is I box. I go to a boxing club 3 days a week, and I have been for over 8 years. So I my husband and I go now
Hmm.
together twice a week, and we actually put on boxing gloves, headgear, mouth gear. We use as a bit of marital therapy twice a week.
So is this traditional boxing? It's not like kickboxing
No,
and
no,
stuff. Okay.
traditional USA boxing.
Okay.
And when our
George
kids
Foreman
were,
style.
so
Ali.
yeah, and then when our kids were still in high school, they used to go too. So it was a family affair. They're
Okay.
graduated in college now,
Yeah.
but yeah, it was a great outlet for us in terms of getting aggression out and stress out.
Well, it's a good
But
way to
that's what
work up
I
a
do.
sweat.
Yeah,
Yeah. All right.
yeah.
I'll be nice to you from now on, knowing that.
I got a mean right hook.
Yeah, no doubt. What else would you like to share with our community before we wrap up?
Um, I just think that, well, I guess one of the things that I would emphasize, and I'm sure you talk to your clients about this, that really um I I think builds kind of successful succession plans is really thinking about the three legs of the stool. I think one of the things I love about the Exit Planning Institute is it allowed me to start asking or at least inquiring of my own clients around their personal goals, their personal financial situation, not just their business
Mm-hmm.
um, positioning, which is, of course, I feel comfortable with, but maybe less so with the personal and the personal financial planning. But having this idea that all three things have to work in concert to create a successful exit or transition of
Mm-hmm.
the business was really enlightening for me. That's one thing I loved about the curriculum of the Exit Planning Institute. And I think, you know, my clients appreciate that kind of broader
Mm-hmm.
perspective. It's not just about the dollars and cents of their business, but is their business helping them meet their own personal goals and helping them meet, you know, their personal financial objectives as well.
Yeah, and we found that a lot of times people need help clarifying what those goals are and clarifying their financial needs, and that can be a stumbling block. And just I don't know what I'm going to do with myself. I don't know how much money I need. I don't know who to contact. I don't want to contact anyone because it's going to cost me a bunch of money. So I'm just going to not think about this. And all of
Hmm.
a sudden another five years has gone by and you still haven't done anything. And so, I think we can really serve a purpose of kind of quarterbacking this and driving this. And honestly, that's why we have such an extensive network, because we want to be able to bring in professionals like yourself who can come alongside and help. um, so obviously people who are listening to this podcast know how to get a hold of me, but if they want to get a hold of you, how would they track you down?
So I would direct people to our website, which is
Yes.
www.quistvaluation.com.
Mm-hmm.
And all of our contact information is on there. And there's a lot of good articles on there, how to get started, basic information that you need to even start thinking about evaluation in terms of documentation. So there's a lot of resources on our website. And so I would start there, or Phil, they should call you.
Yes, they should. And I was just going to say, I'd prefer you work through me. I'll lead you there. I'll show you what you need to see. But
Yeah.
no, I'm an open book here, so I'm pulling back the curtain a little bit to our clients and showing them kind of what's going on behind the scenes a little bit. And I think that just is is a good thing for everyone. So thank you, Shine, very much for this. This has been amazing to get to know you a little bit better and understand what's going on with these valuations.
I
So
appreciate the opportunity and I look forward to speaking with you and your clients some more and seeing how I can be of service to them.
fantastic. Thank you.
Thanks.